Vamos a ir con expertos, vamos a seguir ahondando en los mercados y vamos a hacerlo de la mano de Edward Williams, multi-asset investment strategist en AllianceBernstein. Hi, Edward, thanks for being with us in Negocios TV. It's a pleasure to have you here.
Hi.
Edward, we are talking about the markets. What about the volatility return to markets in the past few weeks with the index in all high times? How sustainable is this rally, and are we in an AI bubble?
I think it's true. We've seen it's run up a lot, right, since late 2022. But I think actually, if you compare the duration of this rally versus prior bull markets, it's probably middle-aged and not super old. So we also know that these bull markets don't typically die of old age. They die of shocks or they die of excesses. I think from our perspective, I think the market backdrop is generally constructive for equity markets. Growth is expected to be in and around trend, and the Fed has ample dry powder to cut rates more if that growth picture comes into question. So I think for us, it makes sense to hold a bit of equity in your portfolio. I think there's some opportunity cost from potentially coming out of equities too early. In terms of the question on the bubble, I think one of the defining features of this market has been that narrow leadership. We've seen AI kind of tech-focused stocks powering really strong gains at the index level and created this kind of K-shaped market where you have a few big winners and quite a few that are lagging somewhat. That's definitely been very beneficial for certain parts of the market, but we also think that this introduces a degree of fragility. So you have the US economy at the moment that is sort of asymmetrically exposed, I'd say, to the AI trade. You have the wealthiest households owning most of the equities, and they typically drive consumption. So if we were to see some kind of AI bubble burst or correction in that AI trade, then I think that could hit spending pretty hard and potentially cause some material economic weakness. But I think that's not our base case. I think for now, fundamentals are relatively reassuring. It's earnings growth that's driven this market, not really kind of multiple expansion. Hyperscalers, we're seeing a ton of CapEx there, and while it is eye-wateringly high, it's largely been funded by strong cash flows rather than debt. But that is something that we're watching very, very closely.
Edward, talking about the equity, on the equity side, where else are you finding opportunities?
Sure, we still like tech, but we're very mindful of valuations. Rich valuations don't necessarily predicate for near-term returns, but what they do is raise the risk of drawdown and magnify kind of the impact of bad news. So we think this narrow leadership and the rich valuation, they call for the need to diversify both across and within asset classes. So one of the areas that we like at the moment is low vol equities. They can offer that more sort of defensive profile. They're pretty cheap versus the rest of the market, and they typically outperform if we see growth disappoint to the downside. That again, not our base case, but I think quite a nice hedge if you do have a tech-heavy allocation. The other area we like within equities, and we think is well positioned for next year, is EM, supported by lower local rates, earnings growth that's expected to be somewhere in the mid-teens, and possible further dollar weakness. We've seen the dollar come off a fair bit already this year, but we think there could be a little bit further to run, and that should support EM equities into next year and beyond.
Talking about equities, we want to talk about the fixed income. The Fed is expected to cut later today, but how do you expect the global monetary policy to evolve as we move through the next year?
I think when the Fed resumed their cutting cycle a couple of months ago, I think that was clear intention from them that they were prioritizing the labor market side of their dual mandate. I think in the US, as you said, a cut in the meeting later today is all but priced. Then the consensus from the market is that we'll get another couple of cuts in 2026, and that is broadly in line with the view of our team, and is slightly more dovish than we've seen from the Fed's projections. But we will get a new dot plot from the Fed today, and that should give us a decent indication of how or if their views have changed versus where they were in September. I think clearly, though, as we move through next year, what we see in terms of interest rate moves is heavily dependent on both the labour market and the inflation backdrop, and the trade-off between these two will drive the outcome that we get. I think in the US and in the UK, we'll likely get policy rates settling somewhere slightly above pre-pandemic levels. In Europe, we're probably likely to get somewhere towards the upper band of where they were before, but either way, that gives us some dry powder should that growth backdrop deteriorate meaningfully.
And Edward, the last question, the consensus for next year seems pretty positive. What do you see as the biggest risks that could derail the markets the next year?
Yeah, I think it's true. When you read a lot of the outlooks that are coming out around now, ready for next year, I think the general sentiment is very positive. While we also think that the outlook for next year is pretty favorable, I think there definitely are some risks on the horizon and some risks to keep in mind. I think the first is valuations and positioning. I think they look fairly stretched in certain areas. And of course, as we've mentioned already, that has the potential to amplify the impact of bad news if we get any. I think the other key area that we're watching is the progress with AI monetization. CapEx intentions are exceptionally high. And at some point, investors are going to start looking for a meaningful return on that investment.
Worrying for the Fed, worrying for the next year, the opportunities in the equities. Edward, thanks for being with us. Negocios TV, it's a pleasure having you here. Thank you so much.
Thank you.